Welcome to this monthly market update on equity markets. The expected Santa Claus rally in the month unfortunately did not materialize. We had too many variables perhaps which hindered Santa Claus's move in the market. Primary reason being the US Fed policy action. So Fed policy clearly highlighted environment where rates may stay higher for a full year CY 2023, and perhaps equity markets and bond markets both were not so easily prepared for such an outcome. We had a situation where globally the markets fell, Indian markets too had a negative month. But if you look at the big picture was the entire CY 2022. Indian market stayed in its own consolidation phase, nicely maintaining its overall uptick for the Indian investors, especially considering it's a rupee return we are looking at. Globally, it was a tough market across the world, where some of the excesses of past possibly came out to hurt in some geography. In some geographies, the way the environment played out hurt the business fundamentals, especially the Russia-Ukraine war started hurting countries in Europe, maybe Japan, which are seen as a big importer of energy, and their financial conditions for those countries could be impacted. On the whole, yes, equity markets clearly maintain a stance where we all have to be aware that there is a need to be surprised, and market keeps on surprising every time. If I step back exactly a year back and in somewhere in early January, if I would have mentioned that this year we'll have a Russia-Ukraine war, we will have a roughly 450 basis point increase in rates by US Fed, 225 to 50 basis points rate hike by RBI. I am sure not too many of us would have expected a great year for the equity markets, but here where we are, we had a good year for Indian investors. Let's not forget that this for CY22 was mildly positive on a very good CY21. So when we look at a longer term picture, things remain as good as what it is, and the primary story remains growth. We are a growth economy with our own demography, with our own reforms, with our own initiatives on digital infrastructure. We are on track to become third largest economy in the world from where we were at seventh, and moment this 723 happens, it's bound to create its own ecosystem of growth across sectors, across companies, across businesses, and we do expect the same to translate into healthy gains on equity markets front, because as we all know, equity markets respect growth and investors will come in for growth. Looking ahead in CY23, I think couple of real points which one needs to be aware of. One is how do investor class adjust itself to this new rate environment. For many people, equity was more like a TINA factor, the best way to invest when the interest rates were too low. Now that ultra low rates are out of the equation, there are fair chances that for some people who want less volatile return may start opting for a fixed income product rather than equity product. So that's a little bit on the flow side of the argument. On the fundamental side, I think broad picture is still the same. You'll have some deviations here and there on sectors or companies, but that macro roadmap for India is intact. Another variable relevant is the liquidity front. This slightly more relevant from US markets and US FII investment globally, because there are two factors relevant. One is the higher Fed rate. Other is the angle of does the money start looking at some new geography. Perhaps one big thing happening in CY23 is likely to be China opening up. The way a lot of other countries had their own pent up demand revival and great economic growth, you can expect something similar in China. And yeah, equity markets offer a relatively sweet spot of valuation for China is what the broad numbers suggest from when you look at the relative valuations. So you need to be aware of it. It's not something to be worried about structurally, because it's just a question of we possibly growing lesser than China, but in a way it is just a recovery of the previous years when we did very well. So I think that's the macro picture. Last part relevant for India is how domestic policies shape up in the year of elections. As we know, next 15 months we are going to have union elections, and in this journey of next 15 months there are going to be at least 8, 9, 10 state elections which will come up as per schedules, and there will be some sort of change in government policies which we will get some glimpses of in the budget next month. Hopefully that will allow us to take a more concrete view on what sort of sectors and companies are likely to benefit in this year ahead. That's mainly from us, and happy to connect with you next month. Wish you all a great 2023 on every front: health, wealth, and investments.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.